You've been trading for a while now. You read the books, you built the system. You know position sizing matters. You know where your stops should go. You've calculated your risk-reward ratios down to the decimal. And still, somehow, you're not making money. Not consistently. Not the way the math said you would. Here's what no one tells you. The problem isn't that you don't understand risk management. The problem is that you're using it perfectly, for the wrong purpose. You're not managing risk. You're managing anxiety. Let me show you what that looks like. You're watching a setup develop. Clean pattern, strong momentum, entry trigger forming. You calculate position size, 2% risk, textbook. But then, right before you click, something tightens in your chest. What if this one's different? So you cut the position in half, 1% now. Safer. The trade triggers, moves in your direction, hits your target, your original target, and reverses. You made money, small money, safe money, and you feel good. Not because you executed well, because you didn't get hurt. Or this. You're in a trade. It's moving against you. Not violating structure yet, just uncomfortable. Your stop is logical. It's outside the noise. It respects the pattern. But it feels too far away. So you tighten it. Just being disciplined, you tell yourself. Protecting my capital. The market ticks down, touches your new stop, takes you out, then rallies exactly where you thought it would. You just turned a winning trade into a loss in the name of risk management. One more. You hit your daily loss limit, 3% down. You stop trading, walk away, follow the rule. Good discipline, right? Except you don't feel disciplined. You feel relieved. The rule didn't protect your account. It protected you from having to keep making decisions. This is the mechanism. Risk management as emotional infrastructure. Position sizing as a buffer against fear. Stops as permission to escape. Rules as walls that keep discomfort out. And the strangest part? It all looks like discipline. From the outside, from the spreadsheet, from the journal, from the rules checklist, everything appears correct. But inside? Inside, you're not building edge. You're building protection. And that difference is everything. Let's map how this actually shows up. Vignette 1. The half-size reflex. You're scanning the market, watching for your setup. There, right there, everything aligns. Momentum, structure, volume confirmation. Your system says full position, 2% risk. But your hand hovers. This one feels different. Maybe I should wait for more confirmation. Maybe the momentum's too strong. Maybe I'm forcing it. You scale down, 1%, sometimes 0.5%. You take the trade, it works, hits target. You bank a 0.5 R win. And here's what happens next. You feel smart. Not for reading the market correctly. You already did that when you spotted the setup. You feel smart for managing your risk, for being cautious, for not overexposing. The system told you to risk 2%. You risked 1%. The trade worked, but you made half the money you should have made, and you're calling it discipline. This isn't random. It happens most often when the setup feels too good. You're coming off a losing trade. The market's been choppy recently. You haven't traded in a few days and feel rusty. Notice the pattern? The market didn't change. The setup didn't degrade. You changed. Your internal state shifted, and you used position sizing to manage it, not the risk in the market, the risk you felt. Vignette 2. The tightening loop. You're in a trade. Entry was clean. Stop is placed. Logical. Outside recent structure. The price moves in your favor. Briefly. Then pulls back. Not breaking structure, just normal retracement. Noise. But it feels wrong. Maybe I should tighten my stop. Lock in some profit. Reduce my risk. You move the stop closer. Now you're risking less, technically. The market breathes, hits your stop, takes you out with a scratch or a tiny win, then continues to your original target. You just gave the market less room, and it took exactly the room it needed. Here's the thought that comes next. At least I didn't lose. Not, I sabotaged a winning trade. Not, I let fear override structure. At least I didn't lose. And that phrase, at least I didn't lose, is the tell. Because now the goal isn't winning, it's not losing. Position management becomes loss avoidance. Stop placement becomes escape hatching. You're not trading to capture edge, you're trading to avoid discomfort. And every time you tighten that stop early, every time you take profit before the target, every time you reduce size because it feels safer, you're training yourself. Not to trust the market, not to trust probability, to trust the feeling of safety. Vignette 3. The rule as relief. You take a loss, then another, then another. 3 trades, all stopped out. Total, 2.8% down for the day. Your rules say, stop at 3% daily loss. So you stop. You close the platform. You walk away. And here's what you feel. Relief. Not disappointment that you hit the limit. Not frustration that the market didn't cooperate. Relief. Because now you don't have to trade anymore. The decision's been made for you. The rule, the daily loss limit, the max number of trades, the take a break after 2 losers protocol. It's not protecting your capital anymore. It's protecting you from uncertainty, from the next decision, from the possibility of being wrong again. And this is where it gets strange. Because you are following the rules. You are being disciplined. On paper, you're doing everything right. But the function of the rule has shifted. It's no longer a probabilistic safeguard. It's an emotional exit ramp. And you don't even notice, because it still looks like discipline. Here's what happens when you use risk management to manage emotion instead of probability. Your perception warps. Not obviously, not all at once, but slowly, trade by trade, the way you see the market starts to bend. First distortion. You start to see discretion where there's only fear. You tell yourself you're reading the context, being flexible, adapting to conditions. A setup appears. Your system says, take it. But you hesitate. The momentum feels extended. Volume's a little light. Maybe after this candle closes. These sound like analytical observations. They're not. They're anxiety, dressed in technical language. Real discretion refines edge. This kind of discretion avoids edge. It mistakes caution for precision. And every time you skip a valid setup because it doesn't feel right, you're not improving your system. You're obeying discomfort. Second distortion. You confuse smaller risk with better risk. You start to believe that risking less is always smarter. 0.5% is safer than 1%. 1% is safer than 2%. And on the surface, that's true. Smaller risk equals smaller potential loss. But here's what you miss. Smaller risk also means smaller position size, which means normal market noise that wouldn't have mattered at full size, now becomes significant. A 2-tick slippage on a 0.5% risk trade costs you twice the percentage it would on a 2% trade. A small pullback that's irrelevant at proper size now feels threatening. So you tighten stops even more. You take profit earlier. You exit on fear and call it precision. The position size shrinks. The psychological noise amplifies. And suddenly you're trading not to capture opportunity, but to minimize the feeling of exposure. Third distortion. You mistake the absence of pain for the presence of edge. You have a week where you don't lose much. Small wins, small losses, tight stops, conservative size. Net result? Up 1.2%. And you feel good. I'm trading well. I'm staying disciplined. I'm in control. But here's the question you're not asking. How many A-plus setups did you skip because they felt risky? How many trades did you exit early because you were uncomfortable? How much edge did you leave on the table in exchange for comfort? You didn't have a losing week, but you didn't have a winning week either. You had a safe week, and your nervous system logged it as success. Because here's what's actually happening in your brain. Every time you reduce size, tighten a stop, or walk away early, your amygdala gets a reward. Threat detected. Threat avoided. Relief. Dopamine hit. Not from winning, from not losing. And your brain doesn't distinguish between I avoided a bad trade and I avoided discomfort. It just knows thing felt dangerous. You took action, danger went away. Pattern reinforced. Do it again. So now, without realizing it, you're optimizing for the wrong variable. Not for expectancy, not for edge, for the feeling of safety. And the market doesn't care about your feelings. It doesn't reward you for being comfortable. It rewards you for being right, at the right size, for the right duration. But you can't be right at the right size if you're managing your emotional state instead of managing probability. Fourth distortion. You start to see validation in the wrong outcomes. A trade doesn't work out. You had reduced your size. You risked half of what the system called for. The trade loses. And your first thought? Good thing I went small. Not, I undermined my edge. Not, I didn't trust my system. Good thing I went small. You just converted a system failure, your failure to execute properly, into evidence that caution works. And every time you do that, you're reinforcing the pattern that fear-based decisions produce safety, that anxiety is insight, that comfort is confirmation. Or worse, a trade works. You took profit early because you were nervous. The market continued to your original target, then reversed. And you think, see, I was right to take profit. But you weren't right. You were lucky. The trade worked despite your interference, not because of it. And now you've just reinforced early exit behavior with a reward. Your brain logs it. Nervous early exit equals good outcome. Do it again. You're not learning to trade. You're learning to soothe. So why does this happen? Why do intelligent, educated, committed traders keep using risk management as a comfort tool, even when it costs them money? Because it works. Not for making money, for something deeper, for making the act of trading tolerable. Think about what trading actually asks of you. Put capital at risk. Accept that you don't control the outcome. Sit with uncertainty while the position moves. Endure the possibility, the likelihood, of being wrong multiple times in a row. Do all of this while your brain screams that risk equals danger, uncertainty equals threat, and loss equals failure. That's not a small ask. That's a massive psychological load. And most people can't carry it, not without help. So they build scaffolding, tight stops, I can't lose much, small size, it won't hurt, strict daily limits, I have an escape plan, one-to-one risk reward, I only need to be right half the time. These aren't risk management techniques anymore. They're anxiety management techniques. They don't improve your edge. They make the experience of having edge bearable. And here's the part most traders don't see. The scaffolding works. You can trade this way. You can follow all the rules, execute with discipline, manage your risk beautifully, and produce mediocre results indefinitely. Because the system isn't optimized to win. It's optimized to keep discomfort below threshold. And as long as it does that, as long as it keeps the anxiety manageable, the pattern continues, even when it costs you edge. Let me describe what's happening underneath, what the mechanism is actually protecting. You're not avoiding loss. You're avoiding exposure. Losing money is easy to explain. Market was choppy. Got stopped out on noise. Bad luck. But risking full size? Taking the trade your system identified? Holding through discomfort to the actual target? That's exposure. Because now, if it doesn't work, you can't blame caution. You can't say, at least I didn't risk much. You actually tried. Full commitment, full execution, and it still failed. That's the thing the mechanism prevents you from discovering, not loss. What happens when you execute properly and lose anyway? Because as long as you trade small, exit early, tighten stops prematurely, you have an explanation. I didn't really commit. I was being conservative. I played it safe. The question of whether you're capable remains unanswered. You never have to confront the possibility that full execution, sustained over time, still might not be enough. So position size stays small, not because the risk is too large, because full size would remove the buffer between your performance and your capability. Stops stay tight, not because the structure demands it, because tight stops let you fail without testing your actual edge. The stop was too tight, that's why it didn't work. Not, I read it wrong. Not, I wasn't good enough. And the daily loss limit? The max trades per day rule? Those aren't guardrails. They're ceilings. Boundaries that prevent you from discovering how much pressure you can actually handle. Because if you never push, you never find the breaking point. And if you never find the breaking point, you never have to acknowledge where it is. You can stay in the zone where effort and results remain ambiguous, where you never quite know if you're trading below your capability or at it. And underneath all of it, underneath the position sizing, the stop management, the risk protocols, there's a question you're not asking. What if I give this everything I have and it's still not enough? That's the question the mechanism exists to avoid, not by answering it, by making sure it never gets asked. You keep the position size low enough, the stops tight enough, the rules restrictive enough, that you never have to find out. The mechanism doesn't care that you see it. It cares that you need it. Here's what happens if you let this mechanism run unchecked. First, your edge erodes without you noticing. You think you're trading your system. You're not. You're trading a version of your system. A version filtered through anxiety, compressed by fear, truncated by discomfort. A setup that should be 2% risk becomes 1%. A trade that should run to 3R gets closed at 1R. A valid signal gets skipped because it feels aggressive. Each individual deviation seems small, reasonable even, but aggregate them over weeks, months, years, and you're not executing the strategy that has edge. You're executing a strategy that feels safe. And the market doesn't pay you for feeling safe. Second, you become unconsciously dependent on the comfort. You stop being able to trade without the scaffolding, the tight stops, the small size, the daily limits. They're not tools anymore. They're requirements. You can't imagine trading any other way. The thought of risking 2% feels reckless. Holding to a 3R target feels greedy. Taking 5 trades in a day feels impulsive. Not because the probabilities changed, because your tolerance didn't expand. You've been training yourself for months, maybe years, to associate trading with emotional constraint, and now you can't trade without it. Third, you plateau. Your results flatten. Not catastrophically. You're not blowing up. You're not taking huge losses. But you're not growing either. Month after month, slight up, slight down, break even, small gain, small loss. The equity curve goes sideways. And you tell yourself it's because the market's hard, or your strategy needs tweaking, or you need better setups. But the real reason? You've capped yourself. You've built a system, not a trading system, but a psychological system that prioritizes comfort over growth, and you can't grow past your comfort ceiling. Fourth, you lose time. Not days, not weeks, years. Because this mechanism doesn't resolve on its own, it's self-reinforcing. Every time you reduce size and avoid pain, you strengthen the pattern. Every time you exit early and feel relief, you deepen the groove. Every time you hit a loss limit and walk away, you validate the escape. The mechanism gets stronger over time, not weaker. And meanwhile, you're aging. Your capital isn't growing. Your skills aren't sharpening. You're executing discipline that looks correct, produces the feeling of control and leads nowhere. And here's the final consequence. You stop trusting yourself. Not all at once, but gradually, quietly, you start to notice. I knew that trade would work, but I went small. I saw the setup, but I didn't take it. I had the target in mind, but I exited early. Over and over, you watch yourself know the right thing and do something else. And every time that happens, the gap between what you know and what you do widens until you're not sure anymore. Not sure if you can trust your analysis. Not sure if you can trust your execution. Not sure if you even want to trade. Or if you're just managing discomfort, calling it discipline. So where does that leave you? You know the mechanism now. You've seen it in the vignettes. You've probably recognized it in yourself. Risk management as comfort. Stops as escape. Size as a buffer. Rules as walls. You understand what it is. You understand why it persists. You understand what it costs. But understanding doesn't stop it. Awareness doesn't dissolve it. You can see the pattern clearly and still execute it perfectly. Tomorrow, you'll reduce size on a valid setup. You'll tell yourself it's prudent. Next week, you'll tighten a stop because it feels too far. You'll call it discipline. Next month, you'll hit a loss limit and feel relieved. You'll frame it as risk management. And all of it will be true. And none of it will be honest. Because the mechanism doesn't care that you see it. It cares that it works. And as long as it keeps discomfort at bay, it will keep running. The question isn't whether you recognize it. You do. The question isn't whether you understand the cost. You do. The question is, what are you willing to endure to stop using safety as a strategy? And that question, that one, I can't answer for you.